Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for WealthPress. Today is Thursday. It is December the 9th, and it is about 7:29 in the morning. The market's going to open up in 2 hours and 1 minute. I'm being as specific as I can with you. So tomorrow we have big data. Let me just kind of give you a broad strokes. Today we have jobless claims, and the numbers have been very solid. Not expecting anything there. Tomorrow, consumer price index and consumer sentiment. These are very sensitive inflationary numbers, and if the numbers are out of whack, it'll give the Fed more ammunition to take their foot off of the buying bond gas pedal, so to speak. But we'll get into that in a minute. But the big reports are coming out tomorrow, and I think anything that's happening right now is going to be overridden by the concern of tomorrow's data, which means today's market action is mostly random unless we hear something over the next several hours or the jobless claims number is just crazy out of whack, which doesn't seem to be the case because we're moving on the average. The average and the weekly seems to be very much in tune, and I'll show you that. For example, 4-week moving average, 238,000, consensus 210, 229. We've been really moving in that line. There hasn't been any surprises since beginning of summer, if I'm correct, maybe middle of summer. You may correct me if I'm wrong, but the numbers have been steady. So I'm not really seeing this as a driver, but CPI tomorrow is going to be a big driver. Consumer price index, if it starts going unreasonably high, if the year to year, if the food and energy month to month, if these numbers are out of whack tomorrow, if the number is way too high, then the Fed is going to be in a position to take action. So consider tomorrow to be a very important day, and we have consumer sentiment. Now, consumer sentiment is more of a circumstantial report because alone it's not important, but it reflects on retail data. Consumer sentiment is what consumers are thinking, and consumers use and buy consumer discretionary, consumer staples products, and that's 2/3 of the economy. So this number is not a final piece of the puzzle, but it's a really important clue to determine what's next, what's to come. Now, looking at the market today, pre-open, we're a little bit down. I mean, honestly, seriously, based on where we've been the last 2 days, this is not a major surprise. I mean, markets do have volatility. I mean, we're down mildly. We went down overnight all the way to almost negative, like 170, 160, about 80 on the NASDAQ. We're bouncing back pretty good. The S&P was all the way down 22. So nothing crazy, but we are seeing volatility. But in light of the trading action that we've seen in the last few days, let me just kind of go to the SPY. In light of this trading action, which has been pretty significant, things are looking pretty good, and I'm expecting the market to trade higher. We are now 3 days above the 50-day moving average. I'm not going to count this. So 2.5, 3 days, and it looks like we're going to be there today. So the market is definitely bullish. And as you can see here, just as I suspected, we broke the 50-day line, stopped out a bunch of positions because people have their stops at the 50-day line and went higher. If you look at the Dow, you will see that it was the same type of story, but the Dow went all the way to 200-day moving average and went higher. And it looks like it's now 2 days completely above the 50-day line, so we are bullish. Now, the index that I really like here is the Russell 2000 because it's following the rest. It's now above the 200-day moving average, and I think we're going to see more upside from the Russell as well. So I am still bullish looking at the bond market. And again, today, we could have a little repositioning, people taking positions off, profit losses. There's been a lot of volatility. The bond market's been coming off of 155. We're at 149. And I think we're going to go down all the way to the 154, 155 level over the next couple of weeks. The reason we went this high is because of the fear of the Omicron. If Omicron was a big deal, then the Fed would say, hey, we're not going to do anything. But the Fed doubled down and said we are going to do something, and it's not a big deal. So I'm expecting bonds to huff and puff and then ultimately come back down. And I think once they hit this 50-day moving average, they're going to break down and hit the 200-day line. There's just nothing positive for the bond market. We kind of know what the Fed's going to do, and we know that Omicron is not a big deal. So what is the major catalyst that would cause it to go up? It could be the CPI, but here's the thing. Here's the interesting part. If the CPI is really bad, right, that means the Fed is going to take action faster. So if it's bad, it's just going to come down quicker. If it's real soft, well, that means there's not that much pressure. The Fed will just stay the course. So the way I'm looking at it is, it's either going to come down fast or it's going to come down slow. But I'm not seeing any major catalyst for the Fed to say we're going to leave the pedal. We're going to keep pressing the gas pedal on the bond market. I think they're going to start taking it off and off and off, and I think that's what we're seeing. And I think ultimately bonds are going to go down. And if you look at the long-term trend, bonds haven't necessarily been going up. They've been kind of going down. This little rally here, I think, is going to reverse course and come lower because, folks, interest rates are going higher and bonds are going lower. So we're still short bonds. I think we're short around the current price, maybe a little bit lower. But if we go lower from this area, we'll be in a profit zone. Looking at each individual sector, before I get into each individual sector, I want to point this out to you. And this is where I am seeing some downside. The Philadelphia Semiconductor Index, we're diverging on here. And we're stronger than any other index, and it's too much too fast. So the downside from chips may be one of the factors that's causing the market to cool off today. As you can see here, we're a little lower. And if you look at the SMH, which is the tradable asset, you could see that it's actually down 0.41, whereas the SPY is down, let's see here, 0.23. And let's look at the QQQ. The QQQ is down 0.31. So the semiconductors are obviously leading us on the way down because, as you could see, 0.44 now, whereas, again, the QQQ is at 0.31. So we're definitely seeing more pressure from the chip stocks than we are from other sectors. Now let's talk about global economy, and we'll move from there. So investors are waiting U.S. inflation data. That's what I was talking about. That's this data that's coming out tomorrow. Might influence the Federal Reserve decision on whether to roll back economic stimulus. We'll see if they do that. We already have a plan, so it's kind of like, are we going to move it quite a bit or a little? Friday's U.S. inflation data for November indicates whether the Fed might feel more pressure to cool prices by rolling back stimulus that's boosting stock prices. It'll be very interesting to see what they say. Thursday, China reported inflation. What is it with inflation today? Everybody's talking inflation. I should have worn my inflation shirt instead of buy the pullback shirt. I'm having a pullback webinar today, and you guys, there's going to be a link below this video. That's why I'm wearing my pullback shirt today. Also, China reported inflation is price paid by factories for components and raw material eased in November from the previous month's 25-year high. That's interesting. And remember, China is a major exporter to the U.S., so this is very positive. U.S. stocks slipped over the previous 2 weeks due to concerns about inflation and the Omicron variant, which is what I've been telling you, which is why bonds skyrocketed. Stocks steadied after Chief Medical Advisor Fauci himself, that Fauci, said Monday signs suggest it might be less contagious from early variants. Looking at each individual sector, as you could see here, technology's high, but it hasn't taken out the high, which is I didn't think it would. If it takes out this high, we may go up for another round, but I think tech is overbought, and I think we're going to cool off on tech. I really do. Consumer discretionary, notice we're not going up as much as tech. That's retail sales, and I told you we need to cool off on consumer discretionary. If you guys remember, just to refresh your memory, I said that consumer discretionary is going to go down and consumer staples are going to go up. We'll talk about that in a minute. Energy, I like energy right now. I think energy is going to kind of hold this line, remain choppy, maybe go a little bit higher, not seeing too much downside. Real estate is skyrocketing. The good thing about this is partly caused by commercial real estate, but residential real estate looks like it's giving us another major run-up because the fear that we may not see interest rates go higher because of this variant caused the real estate market to rally, and I think that's going to cool off. I think utilities are going to continue moving higher as they've been. They're more defensive. I think healthcare is going to cool off because this rally was caused by the fear of the Omicron, but Omicron is not shaking out, and healthcare has been making lower highs. It hasn't broken the high the last time the stock market did, like right here, like right there. Healthcare did not, so I think healthcare is going to cool off, and I actually shorted a stock yesterday, MDT, based on the pullback, the fact that we're pulling back. But I didn't fade strength. I faded the weakest stock. Basic materials, I think, are going to start coming up some more. Consumer staples, look at that. They're near that resistance level. I told you guys this was going to happen. Remember, I said consumer discretionary is going to cool off and consumer staples is going to be coming up. And we're right now near very crucial resistance level. If we can continue going higher, look at this. We're near like the highs. If we can break out of this level, consumer staples can really rock and roll. Communication sector, I think, is going to go down. I don't think there's much there right now. There's no catalyst. Industrial filled this gap, and I think it's going to continue going higher. And financial, I think, will go higher if rates go higher as well, but there's no major catalyst right now for financial. I think insurance stocks and financial stocks are waiting for tomorrow's data. If tomorrow's data is weak and if is strong, and if the Fed has to take action, then we'll see an upside from the financial sector, and we'll see some upside from the industrial stocks. But consumer discretionary, I'm a little mixed because of the tech, because we've been going up, and there's just not much of a catalyst right now. And with rates going up, that puts a real big wet blanket on technology and consumer discretionary. Now, today is Thursday, and Thursday, what do? I give you the hottest ETF, right, and an option. I like the energy. I like this energy ETF. It made a swing high back right before my birthday on October 26th, and now it looks like it's coming back up. I think, now here's what I want to tell you. Interest rates are going to go higher. It's just a matter of when. And number one sector that benefits from higher rates and inflationary pressure is the energy sector. Yes, the energy sector. And I like the Vanguard one. I like this one right now. It's got really good liquidity. I think it's going to start coming back up. It looks very similar to the Russell 2000, actually, if you want to know the truth. Sort of, kind of. I thought it did more so. But they're both moving back higher. More like the Dow, I guess. Yeah, let's look at the Dow. I think more like the Dow. More like the blue chips, which makes more sense, too. Yeah, there we go. All right, so I think that's going to go up in concert with the broad market, and I am expecting the broad market, especially defensive stocks, blue chip stocks, heavy dividend stocks, Dow stocks, S&P stocks to go higher, and I think energy is going to go up for another round. Now, VDE is the ticker symbol, but if you want the option, you go to March, and you go to the 80, right here. You have good liquidity right here. 80, 81, open interest is fine. I would go with the 80 strike price. I mean, you can go with the 82, but I like the 80 strike price better. And it just traded recently, so this one has some liquidity to it. It's not a crazy liquid, but it's got some open interest and some volume. So it's all right. Just go with the 80. You'll be okay, and it doesn't expire for 99 days. So you've got plenty of time. Bottom line is this. Let me just go back to the futures here. Expect some gyration, some volatility from the market today. Expect the bond market to go a little bit against us. We have a short position in one of our programs, and maybe I'll add a couple of more. But the bottom line is we could be in store for some volatility and going into tomorrow. So brace yourself and prepare for some adverse price action to what we've seen the last few days. And again, I don't think this is permanent. I think it's just the market naturally moving based on what we've seen. I mean, we've seen multi-hundred points moves in the Dow. Now, folks, I've got something important for you. Really, really important for you. Most traders use technical tools or other tactics totally wrong, which may lead to losing tons of money, missing profit opportunities, or even worse. It could push some to simply give up trading forever. I'd hate to see that happen. And that's why today, I'm hosting a complimentary bootcamp training session to teach everyone the 3 most critical components for profitable pullback trading. Look, I'm even wearing my buy the dip shirt. I'm preparing for it already. And that's why you need to click the link below to reserve your spot for today's training session. It's happening at 1 p.m. Eastern time. I'll make sure to put a link below this video. Folks, no fluff, no pictures of me on a sailing boat, no bags of money, no Ferraris, just pure, unadulterated trading action. No fluff. We should have called it the no fluff webinar. I'm not going to be talking about some weird crap. I'm going to be talking about the markets, and I'm going to be showing you how to construct pullback trades that have given us an 83% success rate over the last 69 days. Follow the link below. Learn how to trade pullbacks successfully, the right way, with an edge. Bye. Don't forget, follow this video. And always, make sure to like this video, subscribe to this channel if you're watching on YouTube. Stay ahead of the market. Be the first to be notified when I post my next video. Send me some feedback, support@marketgeeks.com. I want to hear from you. And tomorrow we'll do a weekly recap, talk about biggest winners, talk about some losers, and what to expect the following week. It's going to be a very strategic thing. And again, don't miss today's training. It's happening at 1 p.m. Eastern Time. I'll see you all there. Take a pen, paper, and be ready. I'm going to blow your mind with the material that'll be presented today. Bye, guys.